Welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for today's show. Today is Friday, September 20th, 2024, and busy week. A busy week at Tradier, honestly. To go along with the Fed meeting where basically Jay Powell said, hold my beer and watch this, and decided to go 50 basis points on the cut for the Fed funds rate. So this is one of the first times where I was watching the news, had CNBC on all day long, and almost every pundit that came on said, yeah, the futures are saying there's a 50-50 chance that they're going to do 50 basis points versus 25, but the Fed's not going to go 50 basis points. They're going to go 25. I would say 90% of the people that were on the show were wrong. And I don't really have an opinion on if it should have been 50 or 25. As far as I don't know the data that the Fed has, and I am not an economist. I have my degrees in mathematics, and that's why I like to trade options. So, interesting enough, the markets reacted weirdly. Didn't really know what to do with it. I think, even though the futures market, the CME FedWatch tool kept saying that there was, at one point in time, they said there was a higher probability that they were going to go 50 basis points. And I'm kind of glad they did it. I think it's fun that they just did it. Because they thought they needed to do it. Jay Powell made it very clear it had nothing to do with politics. It had everything to do with data. And I just thought it was a very interesting day in the marketplace. So the market it was just totally mixed all day long on Wednesday after the show. It went up and then went down and then went up again. And then today we're seeing the S&P 500 index just kind of, once again, doing much of the same scenario, not quite sure. And there is the seasonality thing that we have going on. We got the SPX down about 0.5%. Russell's down a little more than 0.5%. If anything, this should have been a benefactor to the Russell and the small cap indexes. And so I'm a little bit befuddled on exactly what to do. You know what? It's not a bad idea to actually maybe sell some spreads today. I was thinking about doing a bearish, still sticking with the seasonality trend. I still think there's going to be more volatility in the marketplace. You would think that the fact that the Fed kind of, I guess I'm going to say, surprised the market by going 50 basis points, that the market would probably take that as positive news. Some people are trying to paint it as a scenario that the economy, that they had to react too quickly with the cuts, and that means the economy is not doing as well. And I don't know, like that's what's going on in the marketplace. So it's a tough market right now, and I still believe that until the election, it's going to be a tough market, trying to decide which way we think it's going to go. So with my SPX trade that I like to do when I'm bearish, there is an adjustment to the trade. We did this trade before and didn't execute on Options Guy TV. We put together on a Monday. We should have adjusted it on a Wednesday. And I do want to, I don't want to try to make an excuse or anything. I literally was on the show, and we usually try to do the trades on the show and make the adjustments on the show. And it was an opportunity to do it, and I just missed that opportunity. And if you didn't adjust at that point in time, that ended up, the market ran back up and the VIX came down. And what ended up happening was that butterfly would have went out worthless. Now, fortunately enough, it is a butterfly. So if you're managing your risk enough, you're not over leveraging, by just putting a butterfly on, that is, as opposed to buying something outright or even doing a spread, they're fairly inexpensive to just do a 1x2x1 butterfly, especially when vol's up a little bit, which it was when we put the trade on. in the S&P 500 index or any other underlying index. So you're kind of managing your risk by the strategy that you're choosing, if that makes sense. So I'm going to choose that strategy. And I have to admit, I'm on the fence here. I kind of think the markets are just not going to do anything. But it is September and October. So could we wake up on Monday and all of a sudden everybody got the news from Wednesday and the market tanked or the market skyrockets on Monday? Like that's possible. I think both of those scenarios are in the cards, that we have 1.5 or 2% move on Monday in some direction. So a part of me is to go to the Russell 2000 index and just do a long straddle. That's one of the indexes that we've talked about a lot on Options Guy TV. And every time we've done a long straddle, they paid out. We just don't do them that often because the market conditions aren't always there. But the flux in the marketplace, I kind of makes it a little bit interesting. All right, let's do the SPX trade and let's get bearish on it today. I just talked myself into it. Hopefully we'll get a little bit of a down day on Monday, and if we don't, we will make the adjustment on Wednesday for sure, if the market does rally 2% or so to the upside. All right. And I digressed a little bit there, but great show on Wednesday for the Chicago Board Option Exchange, or the CBOE Global Markets now. I really hate that name, but that's what the exchange is called. And Tradier got together and did a great event, summit on option trading that is available inside the Tradier Hub and also in the Tradier YouTube platform. A lot of great videos that came out. Definitely think you should review them. And that's why we didn't have a show on Wednesday, because the powers that be, or the necessary producers that help with the show, were all busy working on that big event. Okay, so let's go. So we'll be short and sweet. Oh, and I should mention that on Monday we did a VIX trade, and we got bullish on the VIX once again, September and October, but this goes out to the middle of October. The VIX right now is trading right around 16. It's actually down 2% from when we put the trade on. You just stay the course in that until we get to October. Then we'll start worrying about where it was at. It was, once again, we managed our risk by doing a butterfly, paid $1 for it, and we have solid upside and plenty of time to work with it. So we'll probably look at that trade on Monday of next week. Once we get into October, we'll look at the trade. Once we get down in the last couple of weeks, we'll worry about the fact where the VIX is at and decide if we want to adjust it or if we just want to let it ride and hope for that one big event that drives the VIX higher. Okay. So we are, let's go to the Tradier Pro software. Thank you. And S&P 500 index right now is 5682, up 5682.47, down $31 on the day, 0.5%. Normal move in the SPX. Like I said, the marketplace can't really decide where it wants to go. We're going to go to the Friday expiration of next week, which would be the 27th. So here is the Friday expiration, September 27th, 7 days away, 7 trading days away. Okay. So, 7 calendar days is the way I should say it. And right now the market is at 5681. So normally in the SPX, if I'm setting up a butterfly, my trend has been that to do the modified version of the butterfly. We'll go 20 points wide. The market's at 56.80. That's a really nice price. I like it when it's right next to a strike price. We're going to go 5 points down. We're going to buy the 56.75, then go 20 points from there, and we're going to go down to the 56.55. I'm going to sell 2 of those, and then we're going to stop short and give us some potential. So let me do it this way. We'll make this kind of more of a learning session because we only have one trade that we're going to talk about today. 56.55, and if we go down to make it a normal butterfly, it would be 56.35. So we're going to pay for that. So if we did this trade with 1 week remaining, with the VIX where it is at, 75 is $1.30. That's not bad at all. That's not, yeah. The VIX being where it's at, I'm kind of surprised. I was expecting that to be closer to $2. I've done so many of these. Like, I got the September 27th. All right. All right. I think it might be the fact that we're doing it on a Friday as opposed to on a Monday. I mean, that literally can be the case. We don't have the time decay inside the option contract. So now I definitely want to adjust this, and we're going to modify it. And by modifying it, we're going to go up one strike on our protection, on our hedge, on our short spread, and give ourselves some profitability if the underlying market actually tanked and blew through our butterfly to the downside. So in this instance, we're going to get rid of the 56.35 strike. So we're going to remove that. Let's get rid of it here. And we're going to do the 56.40 strike, and we're going to buy that. So we're going to have to pay up a little bit for that strike. 56.40, and we're going to buy that. So we went from 130 to 250 at the midpoint. Market's all over the place, but I do also see that the market went down. Gosh, we dropped 5 points in a heartbeat, didn't we? We went from 56.80 to 56.75 like that. So that also drove up the price a little bit. I would have expected the price to be about 70 cents more, and now it's saying it is $1.30 more. Still want to do it this way? As long as it's under $3, I prefer to do it this way. So here's going to be the trade. It's going to be very straightforward, short and sweet, and I'll show it to you in the what if calculator, but let's make this official. Here's the official paper trade for next week for Options Guide TV that we're going to look at, and we're going to get bearish in the marketplace. As you can hear, I'm talking myself into this at this point in time. We are going to be buying the 2024 September 27th. This will be the last week for trading in the month of September. And we're going to buy the 56.75 strike put, and at the same time sell 2 of the 56.55 strike puts, and then buy 1 of the 56.40 strike puts. We're going to put this on, and the market keeps wanting to go down, and it looks like we've really just all of a sudden decided that what direction we want to go, huh? I guess we'll go 275, or I could adjust it. Yeah, let's ride with it. 56, okay, 275 right now. We'll keep it right there. For $2.75 for every 1 by 2 by 1 butterfly, every unit that we put on. That means our total risk is $275 plus any fees you may pay to get into that trade. Our upside is going to be the width of the strike here, of the long spread, which is 20 points minus that net debit paid. All right, so let's send this to the what if calculator and pull it down, and I'll show you how big of a deal it is to pay a little bit of that extra money. Like I said, it's usually about 70 cents, maybe 80 cents more for the butterfly. But here's where our market is at. This is where we're hanging out at 56.80. 50 now. We bounce back up. Wow. Okay. There it's back down to 250. All right. Yeah, let's go back to the what if calculator. And so the market's just being crazy right now. 56.80 now. As the market goes down, we would like it to go down about 20 points, which isn't a big percentage move to the downside. Right now, we're down 0.5%, and that's 32 points. So you're looking at a little bit smaller move than 0.5%. You're going to be trading right within that range. And then if the market comes all the way down beyond your long strike on the downside, you still are profitable on this trade. And it's all about what you pay for the trade. If if it goes below that, the butterfly could still be worth $5. And here's why. Because we did a 20-point wide long put spread, and we also did a 15-point wide short put spread to help pay for the long put spread. That's really what a butterfly is. So this could lose on the short spread if the market can continue down 15 points, where this can make 20. So if you do the math there, that means that if the market comes down, excuse me, below this, sorry about that. If it comes down below, this butterfly would still be worth $5, but we paid $275 for it. And because we paid $275, 5 minus $275 means $225 is the maximum we can make if it goes in that direction. Now, if the market goes up, what we'll do is we will buy back one of these puts and sell the most expensive put, the 56.75, and actually just roll into a short put spread, which turns this trade totally bearish or bullish. We go from a bearish trade to a totally bullish trade. So how would that look? Here's the adjustment, okay? We are here. We have our butterfly on. If the market starts going on up, we can then sell, and I'll show you the numbers on the other page, but here's what the concept would be, that this is the most expensive option contract. If we sold that one and bought back to close one of our short options, now all of a sudden, now watch this, all of a sudden, boom. Oh, I got to send this to the what if now. All of a sudden, boom, we are in a short put spread. That simple. So what we do is, and we can zoom in on this so it looks a little bit more like a spread instead of a vertical line. So we're here. We do the adjustment. We sell the most expensive option contract in the long butterfly, and we buy. So I'll do it this way. So we sell the 56.75 and we buy to close the 56.55, and we're here and we do this. All of a sudden, this long butterfly turns into this. And when we do that trade, we bring in a net credit. Now, here's where the situation is. If we do that net credit, the net credit has to be worth more than what we paid for the butterfly initially. That's the whole adjustment. And if the market then whiplashed and came back down, we're just going to close the trade and get out. I don't believe in a 1 week trade that you're going to make 5 adjustments to that trade, or let alone 2 adjustments. I'm going to make 1 adjustment, and if it doesn't pan out, I'm going to just close the trade. So long put butterfly that we have on, and then sell this, buy one of these back. We end up with this position in our account, a short put spread, and we go bullish. So now at this point in time, if I go back to the options grid inside the Tradier Pro, which I do love the way the grid is set up in the Tradier Pro software, and we put that butterfly back on. Let's go ahead and put that butterfly back on. 56.75. We are buying that, going down, selling 2, And then going down and buying 1. There we go. 260. That's perfect. That's right where we started too when the call was on. But the official paper trade was 275. I want to leave it there. Okay, so now here's what you're looking at. Here's the option contracts. And let me pause for 1 second. Yeah, just get that frog out of my throat. Okay, there we go. So if we look at the valuations, right? If the market ran this direction, if the market went against you in that position and the market starts going up, this will be the most expensive option contract, and this will be less expensive. So what we're doing is selling this one and buying that one. So right now, if I'm just looking at the ask prices and pretending that we're going ask to ask, we're talking about this being trading for, and I'm going to round off here. We're going to say $7. We'll call 5. We'll call it 7. So right now it's trading close to $7. The difference between the two. That means that if we did this trade, if we did the adjustment right now, which doesn't make any sense because we just put the trade on, but if we did the adjustment right now, we'd bring in a net credit of $7. Right now, we'd be paying $2.50 for it. And $7 minus that $2.50 means that our total money that we have into this trade is $4.50, net credit, actually. We still have risk because we still have a short spread on. We have the short spread then from this strike, 56.55 down to 56.40, which is a 15-point wide short spread, which is $1,500. So you would have fairly decent risk that you would be adding to the trade. But remember, the market is running this direction and it's in a bullish market at this point in time. So here's the magic. I don't know, the magic what? The magic to the trade or to the adjustment. So right now it's $7. If I paid $2.50 for it, when do I want to get out? And I'm going to get out just based, I'm not doing it off a delta. I'm not trying to get fancy with anything. If this short spread, and let's just put it in there, the adjustment trade. So we're going to get rid of that. And we're going to go down to one of those. 660 is where it's at. It was $7 when we were looking, though. 180. Okay, and that's not going ask to ask. So it's 660. If this trade gets down to where it was $2.50 right now while we're talking about the trade, if our adjustment starts trading for less of a credit, this one would be sell, and this one would be buy. Okay. And if it starts trading for less of a credit, let's say if we're at 250, we'd probably be willing to do it at around $4, maybe 350. That would mean that you have a dollar potential of probability, but you have $1,500 worth of risk or 15 points of risk. But I would put that trade on when this spread starts trading for around $3.50 to $4, a couple of points lower than where it's at right now. Then I'm in a short spread, means the market is going up. You got momentum to the upside, and then you have less days remaining until that expiration date. Very simple, very short and sweet trade. And if the market whiplashes and you find that it's back at your short strike, well, then I'm going to close it out. So we start by being bearish. And if the market says, no, I'm not going to give you your bearishness, we're going to go up. We then adjust it, and then we get bullish. And then if the market whiplashes and once again tries to burn us, when it comes down, we just close it and get out. And that is our entire adjustment on the trade. So that's part of the reason why I don't mind today. Like I was going back and forth on, do I want to just do a credit spread in the SPX, or do I want to get legitly bearish? And instead of just doing a neutral trade, let's try to get some momentum to the downside and hopefully be able to maybe even make some money by the end of the day today. If we can get down towards our short strike, we could even be up enough that we don't have to take the weekend risk. But with that said, if I'm doing this trade, I'm going to be watching what this spread is trading at. And if this spread starts trading around $4, I want to get an alert, and then I want to decide, do I want to make the adjustment at that point in time, or do I want to let it ride for a little bit? And a little bit would be where the market is at during the trading day. Did we hit that point at noon, or did we end up hitting it at 3:30? At 3:30, I want to make the adjustment right away. At noon, maybe I can let it play a little bit, but I want to make the adjustment before the end of the day if I'm going to make the adjustment. All right, if you have any questions, a little bit all over the place, but we have our plan. We're going to put the trade on. We're going to pay $2.75 for it because we grabbed it right at the wrong time. And if we can make a buck today and we see it selling for $1 higher, that would be great. If we go to next week, my goal, if I paid $2.75 for it, would be to try to double. So you're going to want to sell it somewhere close to $6, $5.70, $5.80. That would be my goal on the upside. And as a matter of fact, I would have a limit order in over the weekend to close it out if the butterfly started trading around $6. If the market opens up, and it's going to probably have to open up, I'm going to guess 1.5% to 2% on Monday in order for that spread to come down enough and far enough away from our butterfly on the upside that we would want to adjust it. And then we'll make the adjustment based off of the credit or the closing trade that we would put on. And then we'll let it ride for the rest of the week. That's our plan. And that's it for this edition of Options Guide TV. I don't see any questions. Thanks for stopping in. Please check out the summit. It's all taped, and you can watch any of those shows inside the Tradier Hub. Also, you can follow me on X. My handle is @BrianOverby. We stream these live on X. There's no way to be able to ask questions through that platform, but we do stream live through X through my X.com handle @BrianOverby. And then you can always watch it in the Tradier YouTube channel. So we'll see you this Monday, for which I think is going to be a real interesting Monday for the markets. And until the next time, thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.